I'd like to introduce Mike Sadler. I think this is the third time you've been with us. Welcome back. Always looking forward to seeing what you have to say. And it seems like every time we're at some interesting point in the world of economics. So been very much looking forward to it. And take it away, Mike.
Thank you very much, Larry. And let me get the wrong glasses on. So now I can actually see you. I appreciate that, Larry. And you're right. It seems like there's something going on every time. And I tell you, to a certain extent, I'm starting to kind of give up on trying to make forecasts. So I'm sure some of you will probably try to pin me down on that. But this is a world that's become a little bit tumultuous in terms of the economic phenomena that we actually see in reality. It's been chaotic in terms of the patterns that we see, the correlations that we see. Things don't really behave the way they used to at the moment. We think probably we're going back to the way things used to be. At the same time, our data is all messed up. We've had all kinds of data issues because of the pandemic. A lot of data is collected via surveys. Some of those surveys require actually people going out into the public. They weren't able to do that. The surveys weren't exactly equipped to handle the types of things that we saw going on. This wasn't a normal type of a downturn. And we had more people out of work for reasons that nobody had ever thought of putting on a survey before. And so we've got a lot of questions still, and I still believe this is probably going to be a defining moment in economic theory. These are the times when we learn. I mean, it's unfortunate that it has to be associated with tragedy so many times, whether it's this time of pandemic or severe economic recessions or even depressions in the past, but we've learned things too. And so that's encouraging. I've titled this presentation to be an update, since this is the third time that I've done this. And I've tried to frame it in terms of how did we get where we are? What is the current situation? How did we get into it? And then to a certain extent, where we're going. And that's going to be a little bit less involved, shall we say. But let's start out with just three big status updates on where the economy where we stand at the moment. We're certainly in recovery, right? We have surpassed the real GDP, inflation adjusted gross domestic product, has exceeded where it was prior to the pandemic, much to everybody's surprise, I think, at this stage. But we're still very much below where we would be if we had stayed on the same trajectory that we were on. There was a lot of attention paid to when measured output, GDP or employment in certain states had exceeded, gone back to the level that it was prior to the pandemic. But at the same time, those are obviously defining moments for us in the economy, but we've lost almost 2 years of progress, right? The economy should have been continuing to grow, and jobs should have been continuing to grow over that period, and they didn't. And so just getting back to where we were is not exactly setting up a goal that's going to be difficult to hit. The economy is going to get there anyway. Okay, and so we're 3 million jobs below where we were before the pandemic started. Okay, we haven't, the economy, the national employment level has not recovered. It has in Texas, but not nationally. We're still about 3 million jobs below the pre-pandemic level. So we're going to be substantially below where we would be if the trend in employment growth had continued in the absence of the pandemic. Yet, we've got an unemployment rate of 3.9%. How does that work exactly? All right, add to all of this things that we've never discussed before in this session, and that is the quit rate, the percentage of employees that are quitting their job in any given month is higher than we've ever seen. Now, this data only goes back to about 2001, 2002. So it's not reflective of all of modern US economic history, but it's still reflective of something being different right now, as you'll see when we see the data. Also, more job openings than we've ever seen. Those two things are obviously related. People tend to quit their jobs when they have a feeling that they've got another job to go to. but we've never seen the magnitudes of the numbers like we're seeing right now. And it does seem, and I don't think this is something that people aren't aware of, it does seem like maybe there's something different going on. Okay, how about inflation, right? We've obviously, what everybody's talking about right now, it's reached levels we haven't seen since the early 1980s. I'm continuing on my participants window to get people coming in on the waiting room, so I'll just admit them while I'm going. So we haven't seen inflation this high in a long time. And we talked about this last year. And I was very much on what's become known as team transient back then, because it started to be a debate amongst economists and policymakers about whether the high inflation was a transient phenomenon and therefore we would expect it to be dissipating, or whether it was something that we could expect to continue into the long run. To this day, nobody's been able to really give a story as to why we would expect high inflation to be persistent. But at the same time, high inflation has been much more persistent than any of us expected it to be. If it was truly a transient phenomenon, then presumably we would have seen inflation start to come down by now. But we'll talk about the causes of inflation and what we can expect going forward, and how we got to where we are is just as important. Okay. Interest rates. Every time I've spoken to this group, every time I speak to every group, I put up the same graph of the 10-year yield over history going back in time to show the trend in the interest rates increasing on a secular trend up until the 1980s and then decreasing ever since. Ever since they've gotten to be in the very low category, which goes back almost 10 years now. We've been having predictions about how the next upcycle is coming. Okay, yet it's still not here. We're in a moment right now where I haven't looked at anything today. I've been too busy, but as of yesterday, the 10-year yield had blipped up closer to 2%. Okay, this is still historically incredibly low. Okay, interest rates are going to remain low as long as financial market participants believe inflation is going to be low in the future. And despite the high actual inflation that we have today, markets are telling us they still don't believe that that's going to be a permanent phenomenon. And so measures of expected inflation driven by market data are in the order of about 2.5% right now, which is much lower than the approximately 7% actual inflation rate we're getting. So the nominal interest rates are tied to expected inflation rates, and they're remaining low right now for one reason, because markets expect inflation to be low in the future. Whether that's going to play out or not, there's obviously a lot of tension there. High inflation today and low expected inflation in the future. There's obviously a disconnect there, but people in financial markets believe that we're not necessarily going into a sustained period of high inflation, which is obviously good news. Okay, part of that belief is driven by the fact that as of right now, markets are predicting 3 to 4 rate increases from the Fed next year. Okay, when the Fed increases their target rate, it's the federal funds rate. It's an extremely short-term rate, as we're talking about.
Michael,
Since the financial crisis.
can I jump in? What slide are we supposed to be seeing?
Slide 4.
Status update, the Fed and interest rates?
Correct.
Okay. Somebody was thinking that we were supposed to be seeing a graph. Continue, I'm sorry.
No, they're coming.
Okay,
This
great,
is all
thank you.
intro. They're all coming.
Okay,
The Fed has another tool at its disposal nowadays. Before the financial crisis, everything was driven by changing the target to the federal funds rate. And by moving that short-run target, they influenced other short-term interest rates in the economy. And then the story was from there that those short-term rates are what determine long-term rates. We'll get into more detail on that in a second. Ever since they implemented quantitative easing in response to the global financial crisis and Great Recession, they've had another tool, which is basically generically these days referred to as the size of the Fed balance sheet. Quantitative easing involved asset purchases, longer-term treasuries, and longer-term mortgage-backed securities. We've never seen anything like that before. This is a new tool And that's meant to directly influence long rates. Okay, so we're moving into an era of what we call quantitative tightening now. Okay, the Fed is going to normalize monetary policy. We've been hearing that for almost 10 years now. Presumably they'll get here this time. So they're going to start shrinking the size of their balance sheet. That's going to have implication for long-term interest rates. Okay, we've never done this before. We tried quantitative tightening, the Fed did, as we'll see in a graph here, in about 2018, 2019. And it didn't go according to plan. And then the pandemic hit. So we never really know how the Fed would have responded and changed that policy because we got hit with another crisis. So this is a recipe for uncertainty in the future. Probably, we're going to have a choppy couple of years probably. And we're going to see that really the Fed is going to be the game that everybody's going to be watching. And it's really been true since the financial crisis, but we're going to go into one of those periods where what the Fed is thinking and when the Fed is going to make its moves on these two separate tools it's got are going to be the things driving financial markets. Okay. So these are the three big topics. That's all I've got this time are three sort of big picture topics. Okay, the real economy, GDP and employment, inflation, and Fed policy in the past. I've always kind of had some pithy titles for this kind of stuff. I think I used them all up. So we'll start with the real economy, GDP, and employment. Let's see where we stand. And what I've done to give you a picture of two recessions is gone back before the last recession, which you can see there, but mostly 2009. It was the biggest recession we've ever suffered in the American economy since the Great Depression. Okay. And it was a doozy, right? It was a big recession. And you can see what happened to gross domestic product as a result. Now, in previous meetings of this group, one of the things that I've presented is showing how when we have recessions like this, right, and even in years following recessions, we revise downwards our estimates. When I say we, it's the government, it's investment banks, it's universities, it's anyone who estimates what we call potential GDP, which is the GDP that the economy would reach essentially if we were running at full capacity. Okay, that's what we call potential GDP, and that's essentially what you want to shoot for in terms of economic policy. Okay, and every time we have a recession, right, what happens is that they revise down their estimate of potential GDP. It's as if the recession had a permanent impact on the American economy that we're never going to get back, we're never going to recover that previous trajectory. There's an inherent bias in doing that on the recessionary side because when we're in an expansion, we don't revise it up. Okay, and so it's this problem of once we get into a recession, then we don't even try to get back on the previous trajectory. We just revise downward the trajectory and say, this is where we should have been all along. And that's essentially what's happened. Okay, this dotted line is just, these dotted lines that I've drawn here are just my own unscientific projections of trends, right? There are much better ways of doing this in reality, but this is just for illustrative purposes to show you. Right, here's the trajectory down here at the bottom. I can't use my iPad with my pen, so I'll have to wiggle my cursor around. Oh, it gets big if I wiggle fast. That's good. So you can see that the trajectory, we hit the recession. If we had continued on the same trajectory, look where GDP would be, right? Today, all the way up here, right? I'm not saying we would have been on that trajectory, but maybe we should have been shooting for something along those lines, since that would have been the agenda prior to 2008. And so we get hit with a negative shock that brings us below that. We just give up, right? And from then on, we just acknowledge, yep, we're going to be on a lower trend forever now. Okay, a lot of economists are very uncomfortable with that, and I'm one of them. I think it's like punting on fourth down instead of going for it. Yeah. So here's the gap between where we are and where we would have been if we stayed on that same linear trend. And it's massive. I don't even want to estimate it, but it's a significant fraction of the total economy. If we were to continue on the same trajectory that we were on leading into the pandemic, all I've done is project a linear trend from Q1 of actually it's Q4 of 2019, okay, you can see that even though we've recovered substantially, we're nowhere near where we would be if we had remained on that same trend. So despite the fact that what you're seeing here, two other things I'll point out for this graph. We've just been through the shortest recession in American history. Okay, the actual economic downturn that satisfied our official definition of a recession, 2 consecutive quarters of negative real GDP growth. Coming out of the recession, it had to be 2 consecutive quarters of positive real GDP growth. We get this little gray bar here, and that's it. That's the duration of the recession. Very short. It was extremely deep. We shut down the economy. We've never done that before. Okay, but it was extremely short at the same time. There are some lessons there. Okay, here is the longest recession that we've ever had in American history since the Great Depression, which was, I mean, almost a 10-year recession. But we've never had one this long until we reached the global financial crisis and the Great Recession. Okay, and you can see that we never really recovered from that one, never got back on our previous trajectory. Who knows where we're headed on this one? Here's the same basic diagram using employment instead. Okay, this is total non-farm employment in thousands. This is typically the way that we measure employment in the economy. The non-farm number is the one that you'll see when they talk about the employment numbers coming out every single month, right? And so you can see again, right, if we had kept on the same trajectory, look how many jobs we would have in the economy right now. Right, and if we had kept on the same, if we keep on the same trajectory from the current recession, okay, look how far below we are below where we should be if we had continued on that trajectory. Even if we don't account for that, we're 3 million jobs below pre-pandemic employment. Okay, that is a huge number, and it's something that has been discussed quite a bit. There's a lot of frustration about this. Yet at the same time, right, every time I turn on the TV when it's, the right talking head is on, all I'm hearing is about how tight the employment market. The job market is so tight because the unemployment rate has gone down to 3.9%. We're almost down to where we were at the lowest point before the pandemic hit. Okay, so what's going on? And the answer is related highly to things that we've talked about in this session before. Okay, because as we've discussed before, and there's no quiz or anything like that. I didn't expect anybody to come prepared, but the unemployment rate itself can be disaggregated into 2 determinants. Okay, those 2 determinants are the employment to population ratio and the labor force participation rate. Okay, the unemployment rate is going to go down as the employment population ratio increases. This just means more people, more of the total population have a job. That's as simple as that. Okay, and so other things equal, the unemployment rate will go down when the employment to population ratio is going up. Okay, and it has been going up as we would expect, recovering from the downturn that we were in, but we're still nowhere near where we were. Okay, we've got a long way to go to get back up to the level that we were before the pandemic, and even further to go before we got to the Great Recession and the global financial crisis. Okay, so jobs are, we know the economy is improving. We know that we don't have enough people in jobs yet. This is also reflective of that. Okay, so how in the world, given what we're looking at, can the unemployment rate be continuing to fall and falling to near its historical low? Well, that's the other determinant of the unemployment rate, the labor force participation rate. The fraction of the labor force, the fraction of the adult population that's in the labor force, that is either working or actively seeking work, okay? And so when the labor force participation rate goes down, that makes the unemployment rate go down all on its own, okay? And so, but that's not reflective of a healthier labor market. It's reflective of the fact that people are dropping out of the labor market. So what we're seeing here is people dropping out of the labor force. They neither have a job or they're actively looking for one. It's recovered some, but it's stayed largely flat from there. Okay, we're a full 2 percentage points below where we were before the pandemic, more, and we're dramatically below where we were before the Great Recession. So this is what we had discussed in previous meetings here, that the reason why the unemployment rate was reaching historical lows was not just based on good news. It can be based on bad news too. A lot of the people dropping out of the labor force are not doing it just for, say, demographic reasons. They're retiring. It's because they've given up. They're what we call discouraged workers, right? I can't find a job. What's the point of even looking for one? Okay, and that participation obviously fell dramatically during the pandemic. It hasn't increased very much, right, since then, and it's stayed level since then. That in itself makes the unemployment rate go down. But it's an artificial sense of, there's an artificial sense in which the unemployment rate is low there. And so you've always got to be suspicious of politicians. And we heard it through the entire Trump administration. Now we're hearing it through the Biden administration. Look how great we're doing. The unemployment rate is so low. Well, that unemployment rate is not truly reflective of the distress that we're seeing in labor markets. Here's an example. Okay, so this is the employment to population ratio here. You can see what it was before the pandemic started, and you can see what it was in the most recent data. This is the labor force participation rate, which is just the total labor force divided by the population. Okay, it was 63.4% before the pandemic started. Now it's fallen to 61.9. What if I take our employment to population ratio now, which is not very good, and I just apply the labor force participation rate from February 1920 as if this was the labor force participation rate? If that were the case, our unemployment rate would be 6.2% today. So this is just meant to illustrate that one of the primary reasons why the unemployment rate is low is just because the labor force participation rate has fallen so much. Okay, so truly trying to get a handle on distress in labor markets or lack of distress, okay, I should be clear about that, requires more than just looking at the unemployment rate. But we're getting very mixed signals here, obviously. This is an indication that there's more distress than we thought, okay? This is the prime age labor force participation rate. This is watched very closely, so I wanted to put it up just for completeness. Instead of all adults, this is just 25 to 54. Those are considered the prime age for working. Okay, you can see that's fallen fairly dramatically and not increased very much. A lot of economists will emphasize this one and say, even though the main labor force participation rate looks terrible, the prime age one does not. Well, we're not really seeing that here. It has not recovered to anywhere close to where it was prior to the pandemic either. Most of this appears, we get some data that allows us to understand why people might be leaving the labor force. It's a little bit confused at the moment because the surveys aren't rich enough. And so most of this is turning out to look like retirements, or early retirement. So it's as if people 54, 5 and older, some of them, they get hit with this bad economic shock and they just say, oh, I know I was going to work 5 more years, but I think I'm just going to retire now. And it does seem to be that a lot of that is going on. It's almost a discouraged worker type of phenomenon. Okay, I don't think I can really come to any fundamental conclusions about where this is all headed from all of this. This is a really tricky phenomenon. And hang on one second. I'm going to scroll through a little bit here and see if, because I appear to have misplaced some data that I was intending to show you. And I don't know where it went. Hang on. I just put it in the wrong place, I'm guessing. Well, what I don't have up here that I can't figure out where it went, I don't know what I've done. I have the data on the quit rate and the data on the job openings rate. So you can see the quit rate increasing to higher levels than we've ever seen before. More people are quitting their jobs as a fraction of the, I don't mean in absolute numbers, I mean it's a percentage of people who have a job. More people are quitting now than they ever have. Okay, and we've got more job openings than we ever had before at the same time. Okay, this has been broadly labeled the Great Resignation. You are probably aware of that. Where some of it came from is obvious, right? Where there were substantial benefits distributed during the pandemic, and much of that was designed to keep people out of work. It may have had the impact of keeping people out of work longer than intended, but there's not that much evidence to support that. It almost does appear as if we're seeing something new going on. Labor economists are all over this, obviously. And it does appear that there are motivations going on that are beyond just pure monetary. There are people who don't have any money that aren't necessarily going back to work. It's as if the pandemic provided them with a new approach, a new way of earning a living. Maybe they've got a side hustle, right, that's not being reported, something like that. But we does seem like there's a phenomenon here where workers are starting to recognize more bargaining power and realize that you read articles about the anecdotal stories just in the newspaper and stuff. And, people are interviewed and they're just saying, I don't want to go back and work for that guy. It's like, he was a jerk and I don't want to do that. I'm going to wait until I find something suitable and a job that I really want to go to. And I'm tired of, being the one that gets dumped on at work all the time. And there's a lot of people saying that when reporters go out there and ask them, why aren't you going back to work? Is it just because you got enough money? And they're like, no, it's got nothing to do with that. I'm looking for the right thing this time. I'm not just going to jump in. I've just gone 2 years and survived it, so I think I can make it a little while longer and try to find the right thing to do. That's all extremely anecdotal. There's no economic theory underlying any of that, but it does seem to be that there's something different going on in jobs markets. Okay, so let's talk about inflation. This is what everybody's talking about now. Okay, and so there's actually quite a bit of what I would consider to be unnecessary debate, even amongst economists. And a lot of it just seems to be people wanting to get their name out there sometimes. We know, it's been recognized by macroeconomic theory for generations, really, what the causes of inflation are. Aggregate demand, this is a little bit of economics 101 here. Total spending on final goods and services in an economy. Aggregate supply is the productive capacity of the economy. It's not much different from the microeconomics, right? When you have excess demand, a shortage, prices are going to go up. This is the same thing at a macroeconomic level. So inflation occurs when aggregate demand, total spending in the economy, exceeds the productive capacity of the economy. Okay, and so there are two things at work here. There's a demand side and there's a supply side, right? We know that household consumption is driven part of this in the United States, and we'll see that. But at the same time, we're having these supply chain disruptions and other things that are influencing the supply side. So at the same time, the demand side has been essentially booming in certain areas that we'll discuss, right? The supply side is being hamstrung by all these things going on. That's a recipe for inflation. Aggregate demand is going to exceed aggregate supply. There's going to be shortages of goods, and that's going to drive prices up. Okay, this seems to be basic economic theory. There are some other things going on. By way of how did we get there? Okay, how did we get here? Let's look at the demand side. We just, as I said, had the biggest, most severe downturn in the economic history of the United States. And yet, this is what happened to real disposable personal income. Real income means it's been corrected for the effects of inflation. This is all in 2012 dollars. Okay, disposable means it's all your taxes have been taken out. So this is just money that you have at your disposal to spend as a household. Okay, and look what happened as a result of the pandemic. It spiked up 3 different times, all associated with basically checks, people getting checks in the mail. Right? doubt we had very many people getting those here, but if your income wasn't high enough, then you received checks in the mail that allowed people to keep going. I mean, part of the goal here is to keep people at home. I mean, that's what we keep forgetting when you hear all these people talk about entitlements and we just paid people to stay home. It's like, yeah, we paid people to stay home. That's what you do in a situation like this. But what it did was it maintained real disposable personal income at a level that we've never seen in a recession. Look at what happened over here. Okay, you see real disposable personal income coming down as a result of the Great Recession. Right over here, it's coming up. I mean, we've got a little blip over here. We'll see what goes on now, obviously, because the economy has not fully recovered yet, and we're in a precarious moment right now. Okay, but this is unheard of, right? We're in a recession, and disposable income is going up. Okay, look at the deposits at commercial banks. Okay, going up substantially during a recession and continuing that progression, moving up as the money is distributed to households. Okay, and so the end result, this is household consumption. Personal consumption expenditures is just the buzz phrase for it, but this is total consumption by households. Okay, us, the things that we're buying. Okay, and you can see in recessions, boom, it goes down. This is what a lot of what causes the severity of recession sometimes. Consumer spending falls. Fell dramatically during the pandemic, right? But then came back up relatively quickly and is really progressing on its merry way there. Okay, why? Well, because of this, right? This is why, right? We've got all this money at our disposal now in order to maintain consumption. Yep, it fell. God, I'm sorry. It fell dramatically. It's because I'm having to use my cursor as a pointer. I'm dragging my graphs in. It fell dramatically, but it also recovered dramatically. Okay. And there's still some deferred spending in there. People haven't spent all that money yet. Check out this. This doesn't go back to the last recession. This is a much more recent snapshot. Q4 2019, before the pandemic, to Q3 2012. This is the primary reason why we're seeing supply chain disruptions, right? People had income at their disposal, as we just saw, having shutdowns. Service-oriented businesses are getting hammered, okay? And you can see consumption of services, the blue line, falling dramatically, okay? However, durable goods, right? The things that last a while, right? Those demand increase dramatically. Okay, so I mean, these are huge increases because this is 100. These are index numbers. 100 is Q4 2019. We're almost up to 140 up here. 40% increase. These are real products. They're tennis rackets. They're golf clubs. They're camping equipment. All the things that people were buying as a result of the pandemic. New TVs, new computers. All of that kind of stuff, all that money that wasn't going to spending on services, plus some, was going to consumer durables. That is a recipe for a supply chain disruption. Guess where all of those things are produced that we're buying? Not in the United States typically. So we've got to be importing those, right? Services are light and airy. Durable goods are heavy and you have to transport them across oceans. Okay, and that's why we're one of the main reasons why we're in the position that we're in. Now, I wish I had a better graph for this. I got to admit, this is from our last inflation report. Okay, where inflation had turned out to be so high. This is a nice little description here. This is showing price increases. Okay. They're annualized. Okay, well, it doesn't have to be here. It's a year's increase, so it's already annual. Showing between December 2020 and December 2021, what the price increases were for different categories. Now, I know this is really small and you can't really see the numbers properly because it's not a great bar graph, but it tells us everything we really need to know about which of these things are going to be more permanent and which of them are going to be temporary or which can we just not tell. Now, it's always a problem assessing what's going to happen with energy commodities and food-based commodities when we talk about inflation. And that's the reason why when the Federal Reserve targets the inflation rate, they target the core inflation rate, excluding food and energy related prices. Okay, and so the gasoline, gasoline's going way up as pretty much predicted. As the economy opened up, people started traveling more. Gasoline got more expensive again. Not a whole lot that sort of typical monetary and fiscal policy are going to be able to do about that. Okay, which is why I don't want to say it's ignored, but it's just not emphasized when we talk about the policy aspects of inflation. Used cars and trucks, that's very much a supply chain disruption. I mean, this is knock-on effects from the new car industry is what the experts in the industry are telling us. People can't find new cars at the level that they want. They're buying used cars instead. Okay, so this is one, again, we wouldn't expect this. We've been saying this for over a year now, but we wouldn't expect this to continue to be this high, right? As the supply chain disruption issues, which have lasted way longer than anyone imagined, as they start to dissipate, start to be alleviated in the new car industry, used cars the market won't be so tight, and we'll start to see inflation rates of those prices start to come down. Here's our energy again. So two of our biggest categories, right, are not really even reflective of policy. They're as much reflective of what OPEC is doing as anything else. Okay, again, utility, gas service, right? Now, meats, poultry, fish, and eggs, right? We do have some supply chain issues with those. Okay, so again, remember, people have money to spend in their pockets generally, right? And the supply chain is not able to keep up with that demand, which is why these prices are rising. But again, meats, poultry, fish, and eggs, we're talking about, that's looking like around almost a 10% or maybe 11% inflation rate over the year, right? That's not going to continue. We know that. Right? This is something that's going to go away eventually, and nobody really expects that it's going to continue. And so that's going to cause the inflation rate to come down. New vehicles, if they ever get the chip shortages worked out, and I understand they're constantly up against new catastrophes. It seems like every time we turn around, there's a new fire at a chip at a chip fab. The last one I think was in the Netherlands, if I'm not mistaken. Okay, and so that's going to continue to be a problem. And you're seeing stories in the financial press about how long can we expect the chip shortage to last. And there are people talking 2-3 years out still. So if that continues and it results in shortages of new cars, we may continue to see increases in new car prices. And that may then reflect into used car prices as well. Again, here's your food at home and your food. So, I mean, we could go down these, but some of these are really encouraging. Prescription drugs, here's you guys, communication, not much price increase there. Airline fares have gone up almost nothing at all in the past year. Dairy and related products, that's food, we should be skipping over that. Education's not getting much more expensive. Medical care is not getting much more expensive. Alcoholic beverages got us through the pandemic. They're not getting much more expensive. Okay, and so you're seeing some of this start to dissipate already is the bottom line. And so again, I'm trying not to make predictions. I think I predicted last year that by now we would see inflation rates at more normal levels, and yet here I am. We haven't yet. But again, nobody can really come up with a good explanation as to why we would start to see this happen indefinitely. Okay, and so we still can be fairly confident in the inflation rates coming back down. When that's going to happen is going to be very much a function of the two factors that we've been talking about. Do the supply chain disruptions go away so that our productive capacity is back up where it should be? And how much is demand going to be maintained? Now that we're not going to be getting benefits anymore. The unemployment benefits the extended unemployment benefits have expired or are expiring in every state. Where's demand going to go from this? Is the economy going to be able to sustain itself in a way that's going to generate a sustained trajectory? Okay, very much open to question at this point. Just for completeness, let's take a look at wage inflation. Been very much in the news. Workers are supposedly regaining their bargaining power, which they've been losing over the last 50 years in the American economy. right? You can see the percentage change in wages here. All right, ignore the noise. These are compositional effects of people being laid off and then rehired. Okay, but right now it looks like our wage inflation rates are substantially higher than they have been historically. They're still below the overall inflation rate though. So real earnings are predicted to decline if things continue like this. Okay, I would expect wage inflation to be a little stickier, as we say in economics. Okay, I expect wage inflation will continue to remain a little bit higher. This is because, like I said, it appears that something has changed in labor markets. It appears that workers are trying to regain some of the bargaining power they've lost, and they're not willing to go to work in the same jobs at the same wages anymore as they used to. And so I would expect perhaps wage inflation will continue to run higher than we've seen it historically. That may be the only prediction I make, because it'll probably turn out to be wrong too. Okay. And on the supply side, one thing we're hearing more and more and more about, but which there's still not really good data or a good story to tell, is the increase in industrial concentration and how that's restricting supply of many different things. And the pandemic really brought that to light. Before we get to that story, let's just take a look at this. Industry concentration is just how much of the sales of an industry are controlled by the big firms. And we measure that using the Hirschman-Herfindahl index. If you don't know what that is, don't worry. All they're doing here is showing you how much it's increased across industries. This little dotted line down here is the threshold for scrutiny for antitrust cases by the DOJ or the FTC. So you can see the whole point of this graph is to show you that almost every industry in America, right, is more concentrated than they're supposed to be without getting challenged by in court by the Department of Justice or the FTC. And yet, until a couple of years ago, antitrust enforcement was a memory from the past, right? We hardly heard anything about it. That's starting to change. There's pressure from both sides of the political aisle to sort of rein in some of the big tech companies. You hear that quite a lot. Okay, but for our purposes, what this has done, and this is something I should definitely give credit. If you haven't heard of a gentleman, and he's not even an economist, I'm really disappointed to learn that. Man named Matt Stoller writes a blog called Big, and he wrote a really good book called Goliath. He predicted the supply chain disruptions. This article right here, COVID-19 will mark the end of affluence politics, that he wrote in Wired magazine. Look at the date, February 25th, okay, 2020. Right in there, he says, he lists almost all of these industries are in there. Some of them are anyway. Some of these have come up subsequently. And basically he says, this is going to kill us, right? We have allowed so much concentration now that certain we really need are only being produced in certain locations. And if those locations get hit, then we're not going to be able to get that stuff anymore. Even if we can get that stuff, right, the supply chain is going to get disrupted. The ships aren't going to be there. The trucks aren't going to be there. The ports aren't going to be there. And he basically said, I mean, that's not really what's in the title, but he basically said, this is going to shut us down. And we're going to see some severe disruptions in our supply chain. And I don't think anybody really even noticed or took it that seriously. And so it's only subsequent to that everybody's realized, hey, this guy knew what was going to happen ahead of time. And so all of these industries are things that have been impacted during the pandemic. And all of them are examples where you can say that the consolidation has been allowed, mostly in the United States, but also in other parts of the world as well. Okay, and so we, went from, I don't know the ventilator story, but there were all these different companies producing ventilators, and somehow they consolidated, and then there were only a couple of companies producing ventilators. And then when it came time that we needed ventilators, we didn't have the capacity to do it anymore, right? A lot of these are companies that have bought up competitors in order to shut them down, right? Things of that nature. And because we don't really enforce antitrust in America anymore, They've been able to get away with a lot of those things that used to be what we would call per se illegal. Okay, meaning that was illegal on its face and you were going to get challenged by the government or at least somebody else if you did any of it. Okay, so this is something, like I said, we're going to be hearing more and more about going forward. Antitrust has become a thing again. Okay, and it's playing out in the Biden administration, as it's playing out in Congress, it's playing out in academia, and don't really know where it's going. But the fact is, people are worried about the supply chain now and letting the supply chain move abroad into places that are more susceptible and perhaps to disaster, perhaps less friendly, right, is being viewed as taking a big risk now. The word we're hearing now is about resilience, right? How resilient is your company, not how profitable is your company, okay? Because profitability can just entail short run, and that's not good enough in the world that we're living in right now, not for investors. Okay, so let's talk a little bit about Fed policy. This gets a little bit more esoteric, but I'm going to start off with a graph that I've shown you before, and I've been giving corporate sort of talks and conference talks, and I teach MBA students, and they're sort of very much in the business world. I think I've used this graph, updated it, of course. I think I've used it in every presentation of this sort that I've given, I don't know, since 2012. And so this is an unusual graph. And what it's showing is the 10-year treasury yield. And the 10-year treasury yield is just one of our treasury securities, obviously, but it's by far the most liquid. It's the one that everybody sort of knows about. It's a benchmark interest rate that you see every day on CNBC or Bloomberg or whatever. Okay, and so it also happens to be the single largest asset in the world, I believe. Everybody, every financial institution, every major corporation, every insurance company in the world holds US Treasuries. Okay, and so its interest rate is watched very closely as an indicator of a longer term safe rate. The government bond is safe. Okay, and so you can see, going back to the start of this series, back into the 1960s, all the way up to the 70s, there's this general trend upwards in the 10-year yield. And then we get the famous Volcker recessions in the early 1980s, right? Inflation starts to come down. And then ever since then, the 10-year yield was on a downward trajectory. Now, I started showing this graph, I don't know, right about here, okay? And I had this little guy right there scratching his head with an arrow, are we going back into an upcycle? And everybody that looked at this graph would say, oh yeah, you can see how it went all the way back up here, and now it's come all the way back down, and now it's sort of holding steady down here. So the next cycle is going to be back up again, right? Just like it was before. And it just kept going down and going down and going down, and it's never turned. Every time we get one of these upward blips, right? All the commentary is, we're finally out of this low interest rate environment. Okay, the 10-year yield and these other yields are going to start going up again, and then they just come right back down again. Okay, just since the pandemic hit, they've hit their all-time historic low. Okay, and the recovery that we've seen in rates since then is still barely getting us back to where we were last time we hit our historic lows. Okay, so we're hearing a lot again about how interest rates are on the increase again. And so let's just talk a little bit about that, because it's, I want to leave you something here that you may not know, and so I'm actually teaching you something. As I said in the introduction, okay, the Fed now has two tools at its disposal, two basic tools. I mean, there's a lot of discussion about Fed tools, and the Fed has access to a few different tools that it can use to conduct monetary policy, but it doesn't use them typically. Up until the financial crisis, right, going back to the early 80s, the only thing that the Fed had done was control the target federal funds rate. That was monetary policy. Okay, starting in more recent year, after 2000, they started even telling us what that target was. They didn't used to do that. And so everybody knew what the Fed was targeting. You knew what that federal funds rate was. That's an extremely short run rate. It's overnight loans between banks historically, not anymore. That's another topic in itself. So what the Fed would do and it's long-term rates that really matter, right? Think about mortgages and long-term investment by corporations. It's long-term rates that typically matter. And so when monetary policy was used in order to increase interest rates, they would only increase their short-run target, the federal funds rate, and overnight interest rate. That made other short-term interest rates go up. And then some of you may remember from your finance classes that long-term rates, in theory, are supposed to be an average of the short-term rates that are going to prevail over that longer-term horizon. So if short-term rates are going up and expected to go up, long-term rates should go up. And if short-term rates go down, long-term rates should go down. Unfortunately, we learned that wasn't true a couple of decades ago. Alan Greenspan went in front of Congress and said, I did everything I could to stop the housing boom. We kept increasing the Fed funds target. Every meeting, we increased it. And long-term rates didn't go up. He called it the bond market conundrum. So basically, he's saying all these theories that we've been taught in our finance classes about how long-term rates should go up when short-term rates, it didn't work. Okay, that became known as the bond market conundrum. And it became obvious that if we were going to do something about guarantee that we were going to have an effect on long-term rates, which we needed to bring down as a result of the global financial crisis, that the Fed was going to have to go after them directly. Just lowering the short-term target for the federal funds rate was not guaranteed to cause long-term rates to go down, as theory indicated, and the theory wasn't working in reality. So part of the reason why we got quantitative easing is it allows the Fed to go directly after the long end of the yield curve. They can, instead of just buying and selling short-term T-bills, trying to influence the federal funds rate, now they're buying 10-year bonds, 20-year bonds, 30-year bonds, 30-year mortgage-backed securities. When the Fed goes into that market, it creates demand that didn't exist otherwise, causing the prices of those securities to go up and their yields to go down. Another basic premise of finance theory that I hope everybody remembers. And so that's what they do now. Monetary policy is completely different than it used to be. The Fed funds market isn't even a market between banks anymore. There are all these other financial institutions in there. But the Fed controls the federal funds rate, the very short-term rate, in order to try to control the short end of the market. And then it goes into the long end of the market directly as well, buying up bonds. If it's trying to drive interest rates down, that's called quantitative easing. Okay, and so they've got both ends of the yield curve covered now. And in Japan, they call that yield curve control because they're actually targeting a 10-year yield with their monetary policy. We haven't done anything like that. Okay, and so, right, what's going to happen now? We're going to go into quantitative tightening. What does that mean? Okay, let's describe what quantitative easing is real quick. Quantitative easing, the Fed goes to financial institutions all over the country and buys off their books their treasuries, long-term treasury securities, 10-year bonds, 20-year bonds, 30-year government bonds, treasuries, and their mortgage-backed securities. Okay, they essentially took those off the books of the banks and they went on the books of the Fed, which is why the balance sheet of the Fed grew. Okay, that's quantitative easing. Eventually, they reach a point where they don't want to buy new stuff. And that's what's called the tapering. You probably heard that because it's been very much in the news over the last 8 years or so. Okay, and so the tapering says we're not going to continue to buy them. We're going to buy fewer and fewer, and eventually we're just going to let the asset side of our balance sheet just hold steady, which means anytime something matures, because these government bonds and mortgage-backed securities have a maturity date, when they mature, they have to buy a new one to replace it. Okay, so the Fed, every time something on the Fed's book matures, they go out to financial markets, they buy a new, or to the Treasury, and they buy a new one to replace it. So they just keep the balance sheet constant over time. Then we start what we call the runoff. That's quantitative tightening. Let's take a look at history now. I stole this from an article in the Financial Times, and it was just yesterday, I think. Yeah, it's quite handy when things turn up to be helpful in real time like that. Okay, so this is going back to 2012. So this is showing our last episode. This green line here is the Fed balance sheet. Okay, it's showing you that the Fed, the total size of the assets on the Fed balance sheet, which were just over $4 trillion as a result of quantitative easing. Okay, this is the federal funds rate, the short-term rate that the Fed targets. Okay, and you can see what the Fed did here was the Fed funds rate was increasing, and then they brought it down dramatically as a result of the pandemic. Okay, and so that's what you're seeing here. This is the policy rate set by the Fed. Okay, and again, this is the asset side of the balance sheet. That's being measured on this axis. The interest rates are being measured on this axis over here. This purple one is the 10-year yield. So we've got a short run interest rate, a short-term interest rate, and a long-term interest rate here. And so let's look at the relationship between those first. Here's the Fed increasing their short run target interest rate. Finance theory says long run interest rates should go up too. And for a while it did. Okay, but it starts to fall before the Fed ever even levels out, right? The Fed funds target is still going up. Treasury interest rates start to go down now. We're trying to make them go up. We're trying to slow the economy down. That's why the Fed is doing this. At the same time, the Fed is allowing the runoff to happen. They're letting things mature and they're not replacing them now. Okay, so the balance sheet is starting to shrink. Look what happens to the long interest rate. It plummets. Okay, and so this is what's going to happen. This is not exactly expected. Nobody understands exactly what's going to go on with all of this. There's a lot of discussion about the timing. What should come first? Balance sheet reduction or lowering the interest rates or increasing interest rates or increase? What should we do? We got two tools. What order should we go in? We've never had this problem before. They interpreted this as they did it wrong. Okay, so they said, yeah, but we didn't get this right at all. We were increasing the Fed funds target. Okay, and we were essentially, but once we started to let the runoff occur, then the 10-year yield just plummeted. Okay, and it caused all sorts of turmoil in markets as well. I don't know if you remember that period back then. The whole point of this graph is to say, here we go again. We're coming up to something like this again. We know that the Fed is going to increase the Fed funds target at their next meeting. When I say I know that, it's because they've told us. They can always reverse that decision, but they've told us that's what they're going to do. Okay. At the same time, right, they're going to start the runoff. They're going to start reducing the size of the balance sheet. Balance sheet is up, as you can see, right, to $9 trillion now. And they're going to start letting that runoff occur just like they did over here. Okay, that's going to start occurring sometime in the next year too. So we've got the double whammy again. Interest rates on the short end are going to go up. And at the same time, we're going to start reducing the size of the balance sheet. Last time they did the interest rate increases first, started reducing the size of the balance sheet. After that, didn't go too well, right? Who knows what's going to happen this time? The whole point of this is to tell you it's going to get a little choppy. Okay, we don't know what's going to happen. We've never done anything like this, and we've certainly never done it successfully. Okay, and so quantitative tightening is a whole new world. There's a lot of pressure on the Fed right now because inflation rates have gone higher than anybody was really happy with. But it's not really clear that it's appropriate to slow that down right now. Remember, that's largely driven by the supply side, which is out of control, the control of the Fed. If the Fed starts to slow things down now and they move too aggressively and it turns out to be the wrong time, which is what happened last time, we could go into a downturn. The last time we did this graph right here, okay, they had to reverse course, right? Because it started to be obvious that they were slowing the economy down. If that starts to happen again, they're going to reverse course again, right? And then we're in uncharted territory. We really don't know what to do. They're not going to know what to do. They're going to be talking in language that's meant to assuage our anxieties. They say, oh, don't worry, we got all the tools we need to do whatever we want. But, they don't always get this right. And they cause recessions. Historically, the Fed has caused recessions quite frequently. It's not something that we can necessarily jump on them and blame them because they're working with the data that they've got, right? But they do over aggressively tighten sometimes, and they wind up causing recessions. And this is the worst possible time to have something like that happen, when we're still 3 million jobs below where we were before the pandemic started, when we're not even close to being back on our long run trajectory. Okay, so by way of takeaways, I think I've used up my hour. Like I said, I've given up on giving forecasts. Trying to make forecasts during a pandemic turned out to be, oh boy, I don't think I got anything right. I don't think anybody did. I mean, who in the world would have predicted a big run up in the stock market during a giant global pandemic, right? But yet that's what we got. Nobody would have predicted that ahead of time. Okay. My previous presentations have emphasized this phenomenon called secular stagnation. Okay, the idea that our economies, for demographic and other reasons, the economies of the developed nations in particular, China's got some horrible demographic problems as well. Okay, that we're destined for in the long term, unless we do something to change this, that we're destined for sort of long-term stagnation, low growth, low inflation, low interest rates, all driven by low productivity. Okay. Most economists don't really believe that we're out of, just because we've had a pandemic and the world got turned on its head doesn't mean that that's all gone, right? And so the best forecast you can make for the long run is that we return back to that sort of slow growth equilibrium that we seem to be in for over a decade, really. Okay. But there's been a lot of positives come out of this. There's always been a debate about the effectiveness of policy and how to do it to make it more effective. And one thing that we just saw, again, the biggest economic downturn we've ever seen in history, followed by the fastest recovery, all for one reason: fiscal policy. And we did it right this time. Instead of trying to use tax credits and all these other things that we typically do, because for some reason giving money to people is not something that we like to do in America. Those are called entitlements, and that's kind of a bad word. Well, direct payments turn out to be the way to go. When people are suffering and they need help, give them money. And that is the way to conduct fiscal policy. It's much more efficient and it's much more effective. Okay, we're also starting to see coordinated monetary and fiscal policies, which is not something that was ever even considered in developed economies before, say, the financial crisis, and it's gotten that much stronger as a result of the pandemic. Central banks are supposed to be independent. They're meant to be independent of the political process. The Federal Reserve isn't even a government agency, technically. It's a private entity, okay? And it's not supposed to be conducting monetary policy at the behest of politicians, the Treasury, or Congress, okay? But because of what's been going on in the last 10 years, and especially as a result of the pandemic, they're intertwined completely. Now we're using monetary policies for emergencies that are backstopped by the Treasury. The Treasury is giving the money to the Fed to basically to do the policies that it wants it to do. They are intertwined completely. If that had not occurred, we would not have gotten out of the recession. Where we go from here is very much an interesting question, right? Because are we going to go back to the idea that central banks should be entirely apolitical and independent of the political process, and therefore not even in communication, really, not coordinating anyway with the Treasury or with anybody else in one of the branches of government? We're going to be hearing a lot about that. That's going to be very controversial. Certainly in terms of getting your economy out of an emergency, it looks like coordination is the way to go. Whether you want to continue that in normal times is very much an open question still. So that's, like I said, a little bit more esoteric than just looking at what's going on with jobs and stuff. But like I said, the whole game is going to be the Fed, at least over the next couple of years. Is the Fed going to be able to reduce the size of the balance sheet? Are they going to be able to normalize interest rates? right? What order should that go in? How fast should it go? What happens in the interim, and how is that going to influence the Fed's plans? All of this is going to create a lot of uncertainty. And like I said, most likely quite a lot of what I'll call choppiness in financial markets. And I'll leave it at that and open it up for question. I got a whole bunch of stuff in the chat line. I can't, there's no way I can read that in real time, but if you guys ask the questions live and I don't get to them, I'll get to the chat line when I can and answer them then. Okay. I don't think I'm going to be able to answer questions about manipulated data. So,
Well,
okay, go ahead.
Michael, in that question though, how does homes prices, both rent and prices to buy a home, new home and used home sales, how do they work into the CPI? Because
that's the shelter. It's the biggest component of the CPI. So the idea that it's not being counted is just not even close to being true. It's based on rents, and it's based on the imputed owner cost of owning a home, which is also based on rents. So your own home, right? How we value what it costs to live in there is based on the rent, is based on rents. Okay, that's how we measure the value of living in a residence. And so that, like I said, it is included. The part of the owner occupied part is an imputation, as many things are. The rent part is not. And like I said, it's the biggest component of all. It's something like 30% of the CPI is shelter. So it's definitely accounted for.
okay, just to follow up on that to make sure I understand. You say it's accounted for and it's imputed for homeowners, but that's probably reflective of the price they paid, and therefore would be really reflective more of the past, and not
No.
what a new
Current.
home.
It's based on current rents. It's based on current rent, not what you actually paid for your house.
Current rent.
Yes.
Is it put-
So when
so-
rents go up, the owner imputed cost of living in a home goes up with it as well.
Okay, but here in Austin, I think rents maybe the last 2 years went up maybe 5%, whereas housing price, new homes went up 200%. So if you're shopping for a new home in Austin, you feel like there's a lot of inflation, even if it's not going to show up in the rents.
Yes, of course. These are national averages. You can get these measures for the Austin metro area if you want. It won't be monthly data. It'll be quarterly or annual, but you can get that.
Okay.
Yeah,
So-
an average is never going to be reflective of every specific situation, obviously.
right.
But when we
you're-
measure inflation, we're measuring averages.
well understood, of course. It wasn't mean to be argumentative. It's just.
No, I'm sorry. I didn't mean to imply that you were.
So I don't remember the chart. That was kind of hard to read, but was very informative, showing the inflation rates of all the various components.
Yeah, it's a terrible graph. I'm sorry. Let's take a look. It's a terrible. I'm sorry. I should have found a better one, but it was
No,
just
that's
so
okay. I just
comprehensive.
where in here is housing? Sweet.
It's in more than one place. Apparel, other food at home. Here's shelter right here.
Shelter. Okay.
Okay, and I can show you. It may take me a second, but let me show you the breakdown. The easiest place to find this is one of my class slides. Hang on one second. If this isn't really quick, I'll move on. Here it is. Okay. These are the CPI weights. Okay, these are the different broad categories of goods and services that are included in the calculation of the CPI. Shelter's a third of it. Okay, so it's definitely captured. It may not be reflective of what's going on in your town, no doubt, right? But again, you can get that. Well, not necessarily for your town, but for your metropolitan statistical area, that is available. And so you're going to find, if we look that up for the Austin, Round Rock, San Marcos metro area, housing costs will have been going up substantially more than they are in the national average.
Okay.
All true. I don't disagree with any of that. If you live in Austin, your cost of living has gone up faster than it has for anybody else, or for lots of other places, no doubt.
Well, okay, fair enough. I guess for me, it hasn't really, but for somebody buying a house, it seems to probably really has.
Oh yeah, yeah, that's right, no doubt.
I do have another question that's unrelated, but I better make sure. Does anybody else have any questions?
Yeah, I got a question for Mike. So I was kind of picking up from your discussion, comparing the short-term, longer-term interest rates, balance sheet, that there's a theme that it almost seems like the size of the balance sheet affecting long-term interest rates, with that balance sheet being so bloated, and the repurchase of those assets as they mature, creating that demand in the long-term interest rates. It seems like that's kind of creating a ceiling for how far short-term interest rates can go before we start to reach that point where folks get jittery about the inverted yield curve.
That's exactly what they're trying to do, is peg that long end. And that's where I think the Japanese experience is the most illustrative, because they just said our 10-year yield isn't going to go above zero, right? They were in negative interest rate territory. And they said, we're going to conduct quantitative easing so as to make sure that we've got a ceiling on the 10-year yield. The Fed's never gone so far as to formally describe a ceiling, but what you're describing is exactly what they're doing. Is that responsive to your question?
Yeah, it is. I mean, I guess that's kind of a step in the right direction. So have they announced what the intent is for unwinding the balance sheet? I mean, I haven't been keeping up with the Fed. I heard you say that.
We haven't. They're not quite there yet. Last time they did it, they gave us a plan. They told us, here's how much we're not going to renew each month. So as things were maturing, right, when they were holding the balance sheet stable, right, they just bought new ones to replace the maturing ones. Then eventually they said, okay, now we're going to start not replacing all of them. We're only going to replace 20% of them, say, or something like that. And so that's how they started the runoff initially, that they had to reverse. I suspect we'll see something like that. One thing the Fed is very concerned with these days is making sure that they don't surprise markets. And so they're going to tell us ahead of time what their plans are. And so at some point, they're going to say, all right, we're going to keep the balance sheet stable at whatever it is, $9.2 trillion until March, right? And then starting in March, every month, we're not going to renew, we're not going to replace 10% of the maturing MBS and 5% of the maturing treasuries. And then they'll expand that at some point and expand that. And eventually they'll run it back down to wherever they're comfortable with, which we have no idea where that territory is yet.
Thank you.
Sure.
Any questions, anyone? Is somebody here that's actually drawing some, or let's just say on Medicare now, I have memories of stagflation and 14% interest rates and the world of the 70s, where the word arm was pretty disastrous. Is there a chance of stagflation again and insanely high interest rates where if I were to take an arm, I'd be very sorry for it?
I would say probably not. I know that's not exactly committal. A year ago, I would have said definitely not. But we've had sustained inflation, and we just hope that doesn't get sort of ingrained into expectations. Once people start, the problem is if people start to expect really high inflation and that it's going to continue indefinitely, they start acting in ways that bring it about. Okay, and so, for example, if you're a worker and you think inflation is going to be, really high in the future, then you're going to ask for higher wages in your next contract. That's going to actually make, ratify the higher inflation. So it becomes a self-fulfilling prophecy. We don't see anything here that should generate anything like that. So long as we get out of the pandemic and the supply chain disruptions do turn out to be temporary, as what everybody thinks they are, then we shouldn't see anything like that. The problem in the 70s was that oil prices went up fourfold in 73 and again in 79 with the Iranian Revolution. And we were a much more oil intensive economy back there. It took a lot more oil to produce $1 of GDP, for example, than it does today. And so when oil prices went up, it was much more of a burden on the economy. Once people start to expect that to continue, then they start acting in ways where it might continue. And eventually you got to get Alan Greenspan to wring inflation from the system by jacking interest rates up to 25% or whatever. I don't think we've got any of that type of stuff built in here. The phenomena that we're seeing are expected to be temporary. We've been saying that for 2 years now. I don't know how long we get credit, how long we can say that they're temporary, but we don't expect them to last into the indefinite future. It's not that we expected high oil prices to last into the indefinite future, but it went on for so long that people started to expect that it was going to continue. And that's why we think inflation continued to spiral upwards. And when something like that happens, you've got to use policy to essentially intervene and break the expectation that's going to continue. We don't see, you may notice that the Fed is going out of their way to say to us, that's not what's happening. That's not what's happening, right? Well, this is going to go away. This is going to go away. Don't expect high inflation to continue indefinitely, because they don't want to have to deal with that down the line. Once we start expecting it to continue, their job gets a lot harder.
Okay.
I think I stirred things up a little bit more in previous years. I must not be saying either nobody understood it or it was not controversial.
I think
Another
everybody.
question for Michael related to the inflation paradigm. Do you think that we might see an acceleration in the reduction of inflation as the economy starts to open back up and people move more towards spending on leisure and hospitality? Because it seems like right now,
that's a good question.
With everything.
Yes, I do, and we're already seeing some of that in the data. Okay, so here's a way that you can sort of test that yourself as the inflation numbers come out, because all that we get in the mainstream media is the change in the CPI, the price index, going back a year. So it's the percentage increase from December 2021 back to December 2020. So you're going back a full year when you measure that. That's the annual inflation rate. That's the conventional way to measure it. Okay. But I can also take the quarterly inflation rate and annualize that. So what was the inflation rate just between Q3 and Q4, right? Put that in annual terms. And what we've seen is that those are coming down. So the quarterly inflation rates are starting to come down, which is reflective of inflationary pressure starting to dissipate. It's not showing up in the annual numbers yet because we're still going back to a period where the economy was essentially closed and prices were lower than they are today. And so going back a year makes things look worse than they are if we just go back a quarter. And the quarterly numbers have been coming down for the most part fairly steadily. So that's an excellent question. And the trajectory has been consistent with what you said. We are seeing a deceleration. Of course, that could change, right? I mean, supply chain disruptions are going nowhere. China's shutting down cities. They got like 3 infections and they shut down the whole city. And some of those cities are the basis of a lot of the parts and things that we need. And apparently the backlog in the Port of LA is as big as it's ever been. So we got a ways to go.
Thanks so much, Michael.
Thank you, Larry, and everybody else. I appreciate your patience. If anybody has anything they'd like, any further questions, don't hesitate to get in touch. I assume my contact info is available on your program and things like that. So thanks a lot. It's not the same seeing it in person. I like to go to the conference and actually hang out a little bit when it was live that first time. It was great. So
yeah. Well, we miss it too.
nice seeing I recognize some of you. It's nice seeing you again, and take care.
Take care, Michael.